Hello, this is Scott, and this week we're going to talk about taxes, which I know you're really excited about. Nothing gets people more excited than taxes, maybe death. This week what we're going to talk about, we're going to focus on how taxes influence incentives. So the more you're taxed, the less likely you are to do something. The less you're taxed or given an incentive, the more likely you are to do something because you're encouraged. There's an incentive. There's a whole lot of stuff in the book that dives into the details that are just not appropriate for an economics class. They'd be great if you're going into accounting or doing taxation law. Those are perfect. I am not an attorney. I am not a tax expert. This is to talk about consumer economics and how incentives play in. So there's going to be a whole lot of stuff that we're going to just skip. It's worthwhile for you to look at, especially if you have not done your own taxes before, if you're new to that and your parents have done taxes. And they talk about what happens, how does an audit work and all that other fun stuff, which is wonderful and useful information, but we're going to skip. We're going to focus on incentives and how they impact consumer spending. We're going to be talking about the impact of taxation policies. We're going to talk about what the difference is between marginal tax rate and average tax rate. We'll talk about some of the major taxes, and we're going to actually calculate taxable income, which is not the same as your regular income. And that's going to be really important because later on we're going to talk about should you buy a home or not, should you rent, how should do 401ks work, mutual funds, Roth IRAs, and all of these have really strong implications in taxes. So it's important that we get a foundation for what taxes are, but don't go crazy here. So the first thing to know is that taxes really do drive incentives, and incentives drive behavior. If you think about cigarettes, for example, when they add more taxes onto cigarettes, why are they doing it? Well, they're doing it to get tax revenue, but also as the price of something goes up, we know from the law of demand that quantity demanded goes down. We know that incentives drive actions, and taxes have large ability because about a third of people's money goes towards taxes. So we need to talk about that's a pretty big factor and pretty big incentive. We're going to talk about a lot of different kinds of taxes. So we're going to be talking about taxes on purchases, which is like a sales tax. When you go and you spend your money, they tax you at point of sale. We're going to be talking about property taxes. So that's like on a house. They tax you a certain amount of your value every year, and that goes normally to local taxes and helps fund schools. There's wealth tax, like a federal estate tax and state inheritance taxes. And then, of course, the big one is your income tax. Tax on money that you are earning gets, some of it goes to federal, some of it goes to state, if you're in a state that has state taxes. It's important to note that economists categorize these taxes as either progressive, regressive, or a flat tax. And we'll go through an example of each of these, but a progressive tax is one where the rich are paying a higher burden of the taxes. A regressive tax is one where the poor is paying a higher burden of the taxes. And a flat tax is one where it's evenly distributed across the board. So what do we mean by a progressive tax? An income tax, as you earn more and more money, you'll notice that you're getting taxed at a higher and higher percentage. So that gets stronger and puts more of a burden as you earn more money. That's called a progressive tax. This is a marginal tax rate, which we'll get to and explain how that means in a minute. So this isn't an average tax, it's a marginal tax rate, but still this number is going up. A regressive tax would be just the opposite, where this number goes down, where it's a greater burden on those who have less income. You may say, well, why are we talking about that? Federal taxes aren't like that. But think about a sales tax. Let's take two people. Let's take a poor person who makes $10,000 a year and a rich person who makes $1 million a year. The poor person is more likely to spend 100% of their income. The rich person is likely to only spend a fraction of their income. If the sales tax is 10%, that 10% hits 100% of the poor person's spending. The 10% would only hit a fraction of the rich person, the fraction that they're spending. Sales tax, while may not intentionally try to be a regressive tax, is considered a regressive tax because it has a disproportionate burden on the poor versus the rich. A flat tax is one that applies evenly across the board. Why are we going to go through all this effort of taxes? Our goal is to try and figure out as a consumer how to best utilize those limited resources you have. You're on a budget, you have a limited amount of resources. So what we want to do is we want to use tax avoidance. Tax avoidance is legal. It's where you are trying to use legal methods to minimize the amount that you have to pay, but still pay your fair share. So for example, the government encourages you to get an education, and there are benefits that you can have on your taxes by spending money on tuition. That's legal. You want to use those benefits such that it will minimize the amount of taxes you have to pay. That is a realistic and good goal. Tax evasion is illegally minimizing your taxes by doing stuff like saying you weren't working as much as you did, or that not reporting all of your income. That is not what this course is trying to teach you. So we're going to be talking about how to calculate a taxable income. There are lots of terms that are going to come up here. We're going to have to talk about adjusted gross income and credits and deductions and all sorts of other things. And again, I want you to understand the general flow of how this works. This is an online class, so you clearly can use your notes and your book to help guide you through some of the assignments we're going to be doing. Don't get caught up in the real thick details. Again, this isn't a tax law course. If you understand the high levels, you'll understand what we need to do as it gets to the rest of the course. So this is basically everything. What we need to do is we need to come up with your gross income. Every income you're making. So whether it's your wages, whether it's money off of royalties or interest or profit from rental business, whatever it is, any sort of income is supposed to go into gross income. Even illegal income. So gambling winnings, whether it's legal or not legal. If you're selling drugs, it's supposed to go in there. All sorts of income goes into your adjusted gross income. Then what we're going to do is make some adjustments. And we'll talk about what some of these adjustments are in a minute. But sometimes, for example, you may have income, but you put it aside in a 401k, which is a retirement plan, and they don't count it as income now, they'll count it as income later. So what we have then is we have adjusted gross income. Then what we're going to have are deductions. There are standard deductions, which every single person alive gets a set amount every single year. In 2016, it's just over $4,000 a person. Or there are itemized deductions. Maybe you had really high medical expenses, or you had really high other expenses, such as interest on mortgage and other stuff. You get to deduct one of those, and now you're down to your taxable income. Once we have a taxable income, we need to talk about how to calculate the amount of taxes you owe. So what we're going to do is we're going to be talking about marginal tax rate and the average tax rate and how that all works. We're going to be talking about tax credits. So if you are working and they're taking money out of your paycheck every single week, well, that's a credit, right? You've already paid that. And then minus what you still owe, and you'll get to your total taxes. Then the book goes off about how you can submit your taxes and pay electronically and all that other fun stuff, which is all useful and important, but not the focus of this class. First step in determining taxable income is to find all of your gross income. So we are going to just throw everything in there. We're going to throw earned income. We're going to throw income on investments. So that's bought stocks or bonds. You're getting dividends or interest, or you put a lot of money in the bank and you're getting interest on your bank money. Passive income. So if you have a part ownership of a business and you're not actively managing it, but you earn money on it, that's passive income. Alimony, awards, lottery winnings, everything gets thrown in here with a few exceptions. Those exceptions are called exclusions. So there are some things that are tax exempt and tax deferred. A tax exemption could be if you buy a state or federal bond, which we'll talk about bonds later, but it's basically you're lending money to the government and they give you interest on the money. If they're going to give you interest on the money, one way they can make it more attractive is to say you don't have to pay taxes on that interest. We're going to make that tax exempt. We'll talk about that impact in a little bit. There's also tax deferred, which is, think about like a 401k. I don't, but let's say I make $100,000 a year and I could put $10,000 of it aside in my 401k. That now will act like I've only earned $90,000. That $10,000, we're going to defer it, and later on when I start to use it, we're going to start to claim that that was my income later. So that's called a tax deferment. We need to get to this adjusted gross income. This adjusted gross income is that gross income minus the exemptions and exclusions. And why do we need that? It turns out there are a lot of other things that look and say, were your medical costs more than a certain percentage of this adjusted gross income? Were other things a substantial impact in the last year? And everything is determined by substantial as based off of being a percentage of this adjusted gross income. So while it's an intermediate step, it is actually pretty important. Now what we have is your adjusted gross income, and what we're going to try and get to is the taxable income. So there are a couple more things we need to pull out. One of them are called your deductions, and there's something called a standard deduction or an itemized deduction. So a standard deduction, everyone can pull off if they want a certain set number, which is the government basically saying, first X number of dollars, we're not going to tax you on. We're going to reduce your taxes by a certain amount. However, you can also itemize your deductions, and that is in case certain major events happen in your life. slide. So if you have huge medical expenses and it's more than 7.5% of adjusted gross income, then what they're going to do is you can take more than the standard deduction. You can do other things to help reduce your taxable income. Now, just to note, this 7.5% is in talks of being changed. And for the point of this course, it really doesn't matter if it's 7.5 or something else. It's just the logical flow that I want you to understand. Everyone gets exemptions. Exemptions is a set amount that everyone gets to just pull off. The government says, okay, we're not going to count that towards your taxable income. There are many reasons for it, but it's just another way of reducing your taxable income that everyone in the U.S. Gets to have. Quick recap. We found a bunch of gross income. We did some adjustments. We got our adjustable gross income. We can pick either the standard deduction and exemption or itemized deductions and exemptions, and we get to a taxable income. Well, now that we know taxable income, what we have to do is we have to calculate our taxes. So what we need to do is we need to understand how the marginal tax rate works. So let's start with that. So let's pretend you have a taxable income of $150,000. This was what the tax brackets were a few years ago, and it doesn't really matter, again, if they've changed slightly. It's the concept. On your taxable income, the first $9,075 gets taxed at 10%. Because you're making more than $9,000, you're making $150,000, you have $9,075 in that range. And those dollars get taxed at 10%. So you would owe $907.50 on that group. The next band goes from $9,076 to $36,900, and those dollars get taxed at 15%. At 15%, there are $27,824 that you earned in that range. In that range that you made, those dollars are taxed at 15%, so you would owe $4,173. The next dollar you make would fall into this range. Matter of fact, there are 52,000, and every one of those dollars gets taxed at 25 cents each. Then you have some money in this range. There's about $90,000 there, but you have $60,000 in that range. So those dollars get taxed at 28%, and you would owe $16,987. If you add up all those taxes, you would owe $35,175. $35,000 out of $150,000 is, on average, you're paying 23%. However, we often talk about the marginal tax rate. If this is you, and I give you a $1 pay raise, so it goes from $150,000 to $150,001. What would happen? You would have one more dollar in this range. The government would take 28%. So what we say is you are in the 28% tax rate. Although even though you're in the 28% tax rate, you're only going to be paying about 23% of your taxable income, which is less than your gross income, in taxes. So it's worth noting that the blue line is this stair-step marginal tax rate, and this red is the smoother average tax rate. And the average tax rate's always going to be below the marginal tax rate. So I just want to talk for a second about average taxes and marginal taxes. Average taxes are always going to be less than margin. Margin is if you earned one more dollar, how much would the government get? What's more important for behavior is the marginal tax rate. You're trying to decide, well, should I work one more hour or shouldn't I? Should I invest $1,000 in a government bond or shouldn't I? And everything is going to be taxed based on the marginal tax rate. So we want to make sure we understand the difference between average taxes and marginal taxes. It's going to be really important for this class. It's really important for us to understand the difference between a credit and a deduction. A credit is a dollar for dollar reduction in your tax liability. So in other words, when you pay the government out of your paycheck, you are giving them a credit. You are paying them $1 and they're going to say, all right, you can reduce what you owe us at the end of the year by $1. It's a credit. A deduction reduces your taxable income, and it will reduce your taxable income by the amount of the marginal tax rate. So if I'm in the 28% tax rate and I get an energy efficient front door and it costs me $100, then what happens is if it's a tax deduction, I can claim $100 less on my taxable income, and it's like I saved $28. If they give me a tax credit of $100, I actually get to save $100 at the very end, and it's worth $100 to me. So we want to make sure we understand the difference between tax credits and tax deductions. If your eyes are rolling into the back of your head yet, you're not alone, I'm sure. So let's pretend I made $50,000 a year. Okay, so that's what my company is paying me, and I decide to put $5,000 $4,000 away in my 401k. Well, that's tax deferred, so that's going to lower my adjustable gross income. And I have two exemptions, and each person is worth $4,050. I can do an itemized deduction or a standard deduction. So itemized, maybe that was my medical expenses and my interest and other stuff. But the government also says, well, if you don't want to go through all the itemized deductions, we'll just assume that on average for a married couple filing jointly, that you'd have about $10,900 in deductions. So how does this work? My gross income is $50,000. I get to subtract off my adjustments of $5,000, and my adjustable gross income is $45,000. Then I get to subtract off deductions. Well, I only get to pick one of these. I'm obviously going to pick the larger one, $10,900, and my exemptions is $8,100. So I get to take $45,000 minus these two, and my taxable income is $26,000. On the first $9,075, I would pay $907 in taxes. And then on the next $16,924, which falls in this range, I have to pay 15%. So I'd have to pay $2,538. So my total federal taxes is $3,446. If I got a $1 raise, the government would take 15 cents of that, so my marginal tax rate is 15%, but really my average taxes is just 13.3%. My average is less than my margin. My margin is always what I would pay if I earned one more dollar. The book goes on and on and on about how to make payments and electronic payments and whether you should get someone to do the taxes for you, or you should do it yourself, or you can do software tools to help you do it and help you do estimated payments and making tax payments. All of that's super important, but it's not the focus here. You're welcome to look at that if you'd like. And again, this is just the process recap. It's that data flow going all the way through. So you have to figure out how you're going to file, if you're going to file single or married or joint or whatever. You have to figure out your income and adjusted gross income. You have to compute your taxes. You have to figure out what credits you've already paid in, or what credits you may be eligible for things you've purchased. Maybe you purchased a new hybrid car or electric car or something else. Other taxes, payments you've already made, and the refund you owe. This is just, again, a high level how taxes work. And you need to know how deductions work and how the marginal tax rate works, because it's going to play a huge role in investing in the near future.